This is question number 4 on homework 3, capital structure. Green Manufacturing Incorporation plans to announce that it will issue $7 million of perpetual debt and use the proceeds to repurchase common stock. The bonds will sell at par with a 1% annual coupon rate. So this sentence here is kind of telling us because the bond is selling at par. We talk about, I believe, in 605, we talk about the three important relationships. Finance 605, we talk about three important relationships on bond valuation, and the second relationship says that if the bond is selling at par, then the yield and maturity has to be equal to the coupon rate. So basically here it tells us the yield, the maturity of this coupon bond, which is also 1%. Green is currently an all-equity firm worth $19 million with 900,000 shares of common stock outstanding. So from that, we can also calculate price per share for the current or equity firm. After the sale of these bonds, Green will maintain the new capital structure indefinitely. Green currently generates annual pre-tax earnings of $2 million. This level of earnings is expected to remain constant in perpetuity. Green is subject to a corporate tax rate of 39%. So the rounding requirement, unless otherwise noted, round your answers to 2 decimal places. So here you just need to round to 2 decimal places. So part A, the expected return on Green's market value of equity before the announcement of the debt issue is. So remember here, this sentence tells us before the announcement of the issuance of debt, it's currently an all-equity firm and worth $19 million. And it's also telling us the pre-tax earnings, and there's no debt. So what happens is if we use a chart to denote what is going on, you can see. So this is current date. Let's call that 0. And so year 1, year 2, year 3, year 4, and so on and so forth. And there's no end because everything here is perpetual. So the problem tells us basically EBIT, right? EBIT, that's the earnings, EBIT. That equals pre-tax earnings, that's $2 million. But this firm has to pay taxes on this $2 million because EBIT is earnings before interest and taxes, and there's no interest, right? So because currently it's unlevered, so EBT is also equal to that $2 million. And given a tax rate of 39%, we can calculate NI, right, net income. That's also our basically, and because there's no complication for the things like depreciation and working capital, so net income here is also turns out to be the cash flow. So it's this. It's $2 million times 1 minus 39%. That's the net income. So each period, the cash flow, this is the cash flow, will be this 2 million times 1 um 1 minus 39%. So we also know the current value, which is VU, right? Because currently that's unlevered. So current value is given by $19 million. So that's $19 million. And we know the relationship between this value because the current market value of equity should be the present value of all future cash flows, and present now the future cash flows stay constant and last forever. So this is the perpetuity. Now, using the present value of a perpetuity, we know that VU should be CF, so CF cash flow for each period, divided by this R, the discount rate, R0. And the discount rate is what the part A is basically asking us, expected return on the green's market value of equity. So that is the return on the equity, and that serves as the discount rate. Um, so from this, we can solve out this R0 that's simply equal to CF over VU. So now let's use some tools to help us to get the final answer. First, let's get tax rate 39% and EBIT, that's 2 million. So let me use dollars instead of $1 million, and the VU, that's 19 million. Okay, so now R0, that's based on this formula here, CF. CF is 2 million times 1 minus the tax rate. So that equals 2 million times 1 minus the tax rate. And that divided by this VU. So then let's look at the rounding requirement. Here it already gives the percent, so we need to keep this in the percent format and keep two decimal spaces places. 6.42, 6.42. Okay, so that's part A. And part B, construct Green's market value balance sheet before the announcement of the debt issue. So right now, before the announcement of the debt issue, right now, the firm is unlevered. So obviously here debt should be 0. And equity, this is market value based, so we should put everything in market value. So equity is worth 19 million. So here it doesn't mention the units, so we should put everything into dollars. Okay, so this is $19 million. And based on the balance sheet identity, right? Assets equals debt plus equity. So knowing debt and equity, we should also be able to get the asset, which is the same as equity here, right? Because debt is 0. So the total asset is $19 million. You need to be careful about the number of zeros. That's why I tended to be a little bit slow in putting the numbers. Just want to make sure there are no more, no less 0. So this also turns out to be $19 million. So the price per share of the firm's equity, as I think I mentioned earlier, which can be easily calculated by dividing the total market value of the equity by the number of shares. So that's gonna be, so let me put this shares, that's 900,000. Okay, so price, now price This is initial, let's call that P0. Price that equals the VU divided by the number of shares outstanding. Again, let's note the rounding requirement. I think everything should be kept by 2 decimal spaces. So let me just change the format to only keep 2 decimal places. 21.11. So 21.11. So part C, construct Green's market value balance sheet immediately after the announcement of the debt issue. So here, after announcement of the debt issue, the debt hasn't actually been issued yet. It's just an make announcement. But since the market here should be assumed to be efficient. By efficiency, we mean that the participants in the market know that what's going to happen to the firm. So the firm made an announcement that they're going to issue some debt, but that hasn't been issued yet. But that will happen in some future date. So the participants have already factored that new information into their decision making. Hence, they began to trade on such information. Hence, that might affect the stock price. Hence, the equity part of this balance sheet. So that's what we should keep in mind in thinking about this question. And you can see the structure of the balance sheet is already put in this way. The old assets obviously, as we just put earlier, is $19 million. $19 million. Now it has this additional term, present value of tax shield. So what happens here is based on the Modigliani and Miner proposition 1 with taxes, we know that after the issuance of debt, the firm value will be, let's write down it here. We know the relationship, right? VL, that's the levered firm value, equals unlevered firm value, and then times TC times this amount of debt. So that's this proposition 1, given under taxes. Now knowing this B is given, right? The setup tells us the firm will issue $7 million of perpetual debt. So B is $7 million and TC is 39%, and value is as calculated here, is given here actually. So we can calculate this VL. That's basically the total market value of the assets here. So the tax shield is basically this TC times B. Right, the B is, let's keep the debt. That's $7 million. So VL is simply, sorry, we need to calculate the TC. TC times B, because this is B, right? Let me just, to be consistent, just use this to be B. Okay, so now TC times B is this one, 39% times this $7 million. So this is the tax shield, 2,730,000. Okay, so let's put this number back, 2,730,000. And then the total will be the sum of these two, right? The total, this total assets. Total assets will be the sum of this initial VU plus this tax shield. And because here, again, the assumption here is the market is efficient. Efficient means that everybody is rational. So they take into consideration of the future events and factor that into the current price. So that's why we can have this tax shield, even though the debt hasn't been issued yet. So that's the assumption here. So the total asset should be 21,730,000. So 21,730,000. Okay, so the debt, again, because the debt hasn't been issued yet, so this is still going to be zero. But now, based on the balance sheet identity, the total assets will all accrue to equity part of this balance sheet. So now the debt, the new equity, the market value of the equity will be 21,730,000. 730,000. Just make sure the number of zeros matches what's matches. So the total debt and equity is also the same, 21,730,000. Okay, so that's part C. Now D, green stock price per share immediately after the purchase announcement is. So now this is the total equity value after announcement before the issuance of debt. So there's no shares, no equity shares are repurchased yet. Right? So even though this is the purchase announcement, but actually because there's no debt actually issued, so there's no actual repurchase. That means the shares outstanding is still the same as before, which is $900,000. What's changing is this new equity value. So we need to put this new equity value and divide that by, so let's call that P1. So this is the new equity value, which is the same as the total asset value here, but we need to divide that new equity value by the same shares outstanding. That's the new share price. So the share is going to jump to $24.14. Let's keep two decimal places, 24.14. Okay, so 24.14. And green with the purchase. So from here you can see an interesting finding is that the issuance of debt actually helps equity holders. It doesn't help the debt holders. Debt holders also get their they just lend money to the firm and they get their interest payment, and by maturity they get their principal back if the firm doesn't default. But here you can see that with the issuance of debt, with that announcement for the issuance of debt, the stock price will immediately jump. So shareholders actually benefit from this, from adding some debt to the firm's current capital structure. So let's keep that in mind. Green, where they purchase how many shares as a result of the debt issue. So here, because the price already responded to the news, so we need to use this new price rather than the old price of $21.11. We need to use this new price, and the amount of debt issued is $7 million. So we need to divide 7 million by this new price to get how many shares will be repurchased as a result of the debt issue. So shares, let's call that shares repurchase. So that's gonna be the amount of debt, because the firm will use the borrowed money to buy back some shares, and at the new price of P1 instead of P0. So that's very important. So the number of shares will be some fractional number, but in reality that's not possible. But here let's just keep it that way, and let's still keep two decimal spaces. Just keep two decimal spaces. So it's 289,921.77. So why don't we just copy this number back instead of typing that? And then there are how many shares remaining after the purchase. So shares remaining, obviously that's going to be the difference between the shares outstanding earlier and these shares we purchased. So this part is relatively straightforward, and just copy that number back. So F, construct the market value balance sheet after the restructuring. So now let's round your answers to the nearest dollar. Okay, so note the rounding requirement here. All right, so what's changing relative to this balance sheet here immediately after the announcement, but before the issuance of debt, is now we do have this debt. The debt we know that's 7 million, so we can immediately put that amount here. So after the purchase of the equity, now it's like firms have transferred some money from debt holders to the equity holders, right? So the remaining, this is the remaining equity after the some of the equity has been repurchased. And we know that since $7 million are used to repurchase equity, so equity will decrease by $7 million. Hence, the total D&E remain the same as this $21,730,000, same as before. So equity will be so the new equity will be this total asset minus the debt. So that's gonna be 14,730,000. So 14,730,000. And still the old assets is the same as before. So we just copy this number here. Of course, I think we had to make sure this number is correct. Otherwise, you will make double mistakes. Just make sure those numbers are correct. So tax shield is this one. So the total is gonna be the same, also the same as right immediately after the announcement, but before the issuance of debt, same as this one. And finally, the required return on Green's equity after the restructuring is. So here, it's actually examining our knowledge for the Proposition 2, M&M Proposition 2 under taxes. What this proposition says is, with issuance of debt, not only firm value increases, but the debt also adds some risk to the equity holders. So this new RS, the return on equity under debt, is we have a relationship with how much debt the firm has, which is R equals R0 plus B is the amount of debt over amount of equity. Both are in market value format, 1 minus the tax rate, and then times R0 minus RB. So RB here is the interest rate on the debt. So interest rate, I think we are told by to be 1%, right? As we said, because the bonds are selling at par, so the coupon rate is also equal to the interest rate. So this is 1%. Let me just write down it here. And R0 is given, is calculated in part A, that's R0 basically, because R0 is the return on equity when the firm doesn't have any debt, and that's the initial capital structure. The firm is unlevered, so that's 6.42% here. And TCB is given, S is the remaining equity, which is actually based on this new balance sheet. Equity is $14,730,000, and hence we can calculate this number. So let me just put this calculation in Excel. RS equals R0. R0 is here, plus, going back to the formula, B over S, new equity is right here, and then times 1 minus the tax rate, right, the tax rate, and then times R0, and then minus 1%, the RB. So, and then just make sure just make sure we just keep two decimal space. So 7.99. 7.99. Okay, I think we are done with this question. So let me check our work. Okay, great job.